So the Federal Reserve just cut interest rates by 0.25%. And wow, the headlines went absolutely wild, right? Depending on who you ask, it was either a brilliant move to save the economy or a complete disaster in the making. So what is really going on here?
Okay, so which one is it? A genius move or a reckless mistake? Let's be honest, if your head is spinning from all the conflicting news, you are definitely not alone. Did the Fed do the right thing or did they just cave to pressure? The real story, as it usually is so much more complicated, and honestly, a lot more interesting than any single headline.
You've probably heard all the different takes. Story number one, the Fed caved to political pressure. Story number two, this is crazy, inflation is still a huge threat. And then there's story number three, this was necessary to protect jobs. And you know what? There's a little bit of truth in all of those, but none of them are telling you the whole story. All right, so let's get to the real story. It's all about the Fed's truly impossible position. This isn't really about the usual political drama. It's about an economic puzzle that their old rulebook it just wasn't written for. And here it is, the heart of the whole problem. Think of it like a tightrope walk. On one side, you've got a job market that's starting to look a little shaky, and that screams, cut rates now before we fall into a recession. But on the other side, you have inflation that just won't seem to go away, and that screams, keep rates high. So what on earth do you do when the economy is telling you to hit the brakes and the gas at the exact same time? This number right here, 22,000. This is a huge piece of the puzzle. That's how many jobs the economy added in August. And just to be clear, that is a shockingly low number. For the Fed, it was like a giant red flashing light, a major warning sign that the job market was stumbling and they felt like they had to do something before it got any worse. You don't have to take my word for it. The Fed chair himself, Jerome Powell, pretty much summed it all up. He said this situation is just plain unusual. Normally, when there aren't a lot of jobs being created, prices stop going up so fast. It's one of the basic rules of economics. But not right now. Right now, the old maps just aren't working, and they're navigating completely new territory. So the big question is, why? Why are the old rules broken? Well, it looks like there are three massive curveballs being thrown at the economy all at once. First, you've got a labor shortage that's tied to big shifts in immigration, and it's messing with the whole relationship between jobs and prices. Second, tariffs. Who knows what they're doing to prices day to day? It's a total mystery. And third, the elephant in the room, AI. Nobody, and I mean nobody, really knows what its true impact on jobs is going to be. So yeah, the Fed is kind of flying blind through some of this. So how does the Fed explain this move? They're using a very specific term, risk management. Now, this is really important. It doesn't mean they're slamming on the brakes and making a huge U-turn. Think of it more like they're buying a small insurance policy. It's a cautious little step to protect the economy, not a big announcement that the fight against inflation is over. And get this. It's not just the newspapers and politicians that are arguing about this. The Fed itself is divided. Nearly 40% of the top officials, that's 7 out of 19 people making the call, actually wanted fewer rate cuts. Now, that isn't a sign of chaos, it's a sign of genuine, deep uncertainty. When the experts themselves can't agree, you know just how tricky the situation really is. Okay, so that's the big picture of why they did it. But let's get down to what really matters for all of us. The bottom line. What does this actually mean for your wallet? It all boils down to this little number, 0.25 percentage point. I know, it really doesn't sound like much, does it? But believe me, that tiny change sends massive ripples through the entire economy, and it touches everything from your mortgage to your savings account. So let's break it down. Who wins and who maybe doesn't with this cut? Well, if you're a borrower, maybe you have a credit card balance or an adjustable rate loan, this is pretty good news for you. Your payments could get a little cheaper. Now, if you're a saver, maybe not so great. The interest you earn in your savings account will probably dip. For investors, it's complicated. The stock market usually likes rate cuts, but it's also a warning sign about the economy, so it's a real mixed bag. And finally, for workers, well, you're the whole reason they did this. This cut is meant to be a safety net to keep the job market strong. All right, this decision definitely isn't the end of the story. It's really just the latest chapter. So if you want to understand what the Fed might be thinking about doing next, there are a few key things to keep an eye on. Here's your cheat sheet. There are 3 key signals to watch. First, pay attention to the Fed's next meetings and what they say in their projections. That's where they basically tell us their game plan. Second, keep a close eye on those monthly job reports. If those numbers stay weak, you can probably expect more cuts. And third,
Watch the inflation data. If prices start heating up again, all bets are off.
In the end, it all comes back to this pretty powerful admission from Chair Powell. He's basically saying, look, predicting the economy is hard on a good day, and these are not good days. The people steering the ship are telling us directly that the future is more uncertain than ever. This rate cut wasn't a simple choice. It was a calculated bet in a very complex game. And it leaves all of us with a really big question to think about. In an economy where the old rules just don't seem to apply anymore, what new tools are we going to need to get through whatever comes next?